Hello, everyone. Over the past year, we've covered gold from every angle: policy shortages, central banks, audits, and trust. And when we look back, we not only see some highlights, but also a distinct pattern emerging. And when you step back and connect the dots, you start to see what the last year was really preparing us for and what 2026 holds. That number isn't a finish line, it's a flare, a signal, an announcement that something much bigger is happening underneath the surface. Because when gold is surging, doesn't mean that the economy is booming. It means the opposite. It means things are breaking or have already broken. Gold isn't an asset that explodes because we've just discovered the next iPhone. It rises when trust falls, when systems wobble, when people start asking whether the people in charge are really, truly in charge. When gold explodes higher, it isn't reacting to growth. It's reacting to failure. It doesn't spike because the future looks brilliant. It spikes because the present looks unsustainable. Gold didn't spike because of price mechanics. It spiked because the architecture of the global economy is cracking under its own contradictions. This wasn't a rally driven by tech, optimism, or earnings surprises. It was a sudden repricing of safety, a global reassessment of trust. Gold didn't change, the system did. This isn't really about gold going up, it's about money going down. When you say that gold is at or above $3,000, what you're really saying is that right now it takes $3,000 to buy what used to cost you far less. Gold hasn't changed. It hasn't reinvented itself. It hasn't been repackaged. It's still the same lump of metal. What's changed is the purchasing power of your currency. And that change isn't an accident, it's by design. One approach is revaluing US gold holdings. Moves that would raise the book value of gold from its outdated official price of $42 per ounce. Yes, it is still valued at that price despite trading at over $2,900 per ounce. To reflect its true market value, now such an adjustment would instantly unlock trillions of dollars in paper wealth, significantly strengthening the government's financial position and creating new fiscal options. Now, another method is collateralizing gold for new financial instruments. This could involve using gold as security for issuing government-backed bonds, or even creating innovative financial vehicles that integrate that gold directly into the monetary system. By leveraging gold in this way, the US could introduce alternative funding sources without resorting to additional money printing or increasing its reliance on traditional debt markets. China is offering a market where gold is not just a speculative asset, but a key part of the financial system, and crucially, it is creating mechanisms for physical settlement, not just paper speculation. China's proposed reforms to the Shanghai Futures Exchange would open its gold futures market to foreign participants, but unlike the paper-based trading of the COMEX or that we see the LBMA, these contracts are tied to physical delivery. If approved, this change would be a profound shift in the way gold is priced and traded. It would mean that actual possession of gold, not just leverage bets on its future price, would start to determine market value. Gold audit is a structured independent review of gold reserves, and that's to confirm their existence, their ownership, and the quality of that gold. It involves three key parties: the entity that owns the gold, the custodian responsible for its storage, and of course, an external auditor who has been tasked with verifying the accuracy of those records. Independent oversight is, of course, absolutely critical because without it, there's just no way to verify whether or not the gold exists, if it has been lent out or has been otherwise misrepresented. When your thermometer is telling you that you have a fever, you don't carry on as normal. You look for the cause of the fever. And gold at $4,000 is that fever made visible because it is the market quietly whispering at the patient, i.e., the modern financial order is not